Hello traders, it is Matt with Paragon Elite Trading. How you doing? Wanted to run you through the only three numbers that matter in trading. And they are the numbers that determine whether we are gamblers or professionals. Most traders, it's funny when I coach traders, the newer ones will have 100 different indicators on their charts. You can barely see what's going on. Most traders are drowning in indicators, chart patterns, and analysis paralysis. But here's the truth: your entire trading career comes down to just three numbers. If you master these numbers, everything else is just noise. Here we go. If you want to approach the trading like a professional rather than a gambler, you got to understand these metrics. They are win rate, so your win-loss ratio, your risk to reward ratio, and expectancy. Write those down, but we're going to get into them. So pillar one, your win rate. Win rate is important, right? If you trade 10, if you have 100 trades and you win, if you profit on 50 of them, what's your win rate? Obviously, it's 50%. Let's suppose this one's green. Now what is it? 60%, 70%. What if those are red? What if that's red? Now we're 40% win loss, 30% win loss, okay? And so on. So obviously it's important, but as everything else in trading, you got to put it in context. Win loss is not the catch-all. A high win rate feels good, yeah. And I coach a lot of traders that feel really good about their high win rate, but they wonder why they're still not making money. And it's because you got to put things together. So pillar two is your risk to reward ratio. So how much are you risking per trade versus how much you're winning per trade? That way, you know, on the ones I'm winning this much. On the ones I'm losing, I'm only losing this much. So a 1 to 3 risk to reward means if you're making $100 or if you're losing $100 on your losing trades, you're winning $300 on your winning trades. Do you see why that's important? That means if you have a risk to reward of 1 to 3, you only need to win 25% of your trades to break even. Does that make sense? So if you've got 100 trades, on 25 of them, you made, let's say, $3. So you've got $75 in profit. Okay? Got 75 in profit. On the other 75 trades, you lose $1. So you're at break even. So you can have a low win loss rate, but if your risk to reward is high, then you can still be profitable. Trust me, I've had months where my win percentage is in the low 30s, but I've still made a lot of money because my risk to reward is always favorable. This is just another illustration of the relationship. How much are we losing on our average loser versus how much are we winning on our wins? Professionals focus less on being right and more on managing downside. I cannot stress this enough. Professionals do not worry about being right, and I know this because I was one of those ones that when I first started trading, I wanted to be right. I was convinced I was right. I have a significant education behind me. I got an MBA from a very prestigious school. I have my CFA. I'm officially smart, is what I thought. So I was convinced my analysis was right. And it doesn't matter as much as this does. Managing your downside, maximizing your upside. Because Mr. Market will disagree with you at times. And in those times, it won't matter if you're right. Trying to be right and trying to force your opinion on the market, I mean, do I have to say it? You're not going to win. None of us has enough money to win against the market. So don't go against the market. Focus more on keeping your losses small and letting your winners run. All right, the number 3 pillar, the most important as we tie it all together, is the expectancy or expected return on our per trade. So this is where we bring win-loss together with risk to reward. And here's the equation. Expectancy, or your expected return per trade, is your win rate times your average win minus your loss rate times your average loss. So if our win rate is 45% and our average win is $450 and our average loss is $150, that means we've made this much and we lost this much on our losers, so our expectancy per trade is $120. As long as this is positive, you have a statistical edge. Let me say that again. As long as your expected return per trade is positive, you have an edge. If it's negative, you need to go back to the drawing board and figure out what's wrong with your trading plan or your trading system. Okay? This is sustainable profitability using these 3 numbers, these metrics. They're what you need to focus on as you practice and establish what your trading plan will be or your system. And we will never not have to worry about these numbers. Like I said, I've had a win-loss ratio, low, let's say 30%. But I have a different word for risk to reward. I actually call it reward to risk, and in that context, it's called profit factor. And what it means is how many dollars do I gain per dollar of loss? And as long as that gets higher and higher, it's okay if I'm still down here. I don't want to be down here in win-loss percentage, but as long as your risk to reward is favorable, it's going to make up for those times you lose. So, are we gamblers? No, we want to be professionals, and this is how we pass assessments for prop firms. They want to make sure we're disciplined and that we're playing the odds. We're taking high probability trades and that we have a system. Okay? If we do this, it's easy to pass assessments. If we do this, you may pass one, but you're not going to hold on to that account. You're going to blow it. Or you're just not going to pass the assessment, period. So guessing is not a strategy. Hope is not a strategy. Following your emotions will get you in more trouble than anything else in trading. Over here is where we want to be. All right, guys. Thanks for tuning in. We'll see you next module.